All right, what's happening, everybody? Next topic is we've been covering the ratios, but we know to measure performance or risk, we got to look at the ratio relative to a benchmark or a standard. In general, judging performance, it's the actual relative to the budget, and we as accountants know that as variance analysis. So performance metrics, we evaluate, remember, the operating performance. That's what's going to drive value, the core business. We want to look at that operating performance and see how that's going to affect their stock performance. There's a high correlation between the operating income on the income statement and the earnings per share and ultimately the value of the company. So performance metrics, we're evaluating that performance. Now that's important, not only when looking at the current year, but again, relative to prior years, what's the trend? Are we improving or deteriorating? And this is important not only to current investors, because they might want to sell if things they think are going to forecast going down, and potential investors may want to buy if they think things are going to improve, right? So we want to evaluate that performance relative to historical performance and the industry standard. Now, a very important performance metric we haven't covered yet, we've covered EBIT, but what about EBITDA? EBITDA is very important when comparing companies within an industry because number one, it's very difficult to accurately compare companies with very different balance sheets. If you raise your capital through debt, you're going to have lower profit because interest is deducted on the income statement. Conversely, if you raise your capital through equity, dividends are not deducted. Now, debt to equity is important when assessing financial risk, but we don't want to double count the effects of financial risk. So on the income statement, we want to look at the earnings before the interest to assess operating performance. In addition, in capital-intensive industries, EBITDA is very important because that's a measure of operating performance before you subtract out the depreciation and amortization. Now, why do we sometimes want to exclude that from the metric when assessing performance? Because when you're looking at two companies, one with old assets that are almost fully depreciated and one with new assets that were purchased recently that in an inflationary environment costs a lot more, the company with the older assets is going to look better because they're going to have lower depreciation and thus a higher EBIT. So when you want to compare the operating performance of two companies and exclude the impact of financial leverage and exclude the impact of depreciation and amortization, then you want to compare the company's EBITDA. Okay. In addition, depreciation and amortization is not only skewed by the age of the asset, but the method of depreciation, straight line versus accelerated, and estimates like salvage value, useful life. So many times in the real world, companies are valued when we try to come up with, well, what would be an asking price or a potential selling price for a company? Many times they trade at a certain multiple of, we use EBITDA to facilitate a more accurate comparison. Okay, now there's two ways of getting EBITDA. Top down, your sales minus cost of goods sold, minus your SG&A, R&D, but exclude depreciation and amortization. Or bottom up, net income plus your taxes, add back your interest and depreciation. The advantage of top down, it also excludes gains and losses that are unusual or infrequent. So the EBITDA really becomes more of your core business. When you work bottom up, if that has a lot of significant gains and losses in it, it's not as telling insofar as sustainable performance because gains and losses by definition are unusual or infrequent. All righty. Now, earnings per share. As I mentioned earlier, there's a high correlation between what happens to your earnings per share, and your stock price. All righty. But remember, just because net income goes up and earnings per share goes up doesn't mean you should immediately jump on with everybody else and buy the stock. We want to know what's driving that earnings and that increase. Is it something unusual or infrequent, or maybe something highly irregular? Or is it being driven by the core business? I'm impressed if it's coming from the operations, okay? Your numerator is your income available to common stockholders, also known as net income minus your preferred dividends. So assuming the preferred dividends are cumulative, we subtract out the amount that could accumulate. And that's how we get the income available to common stockholders. Your denominator is the weighted average common shares outstanding, so it's self-evident, higher the better. But we want to make sure it's sustainable, okay? So what's happening, is it likely to continue in the future? Today's value is driven by forecasted future performance. Now, remember that earnings per share is also going to be skewed by your capital structure. When a company has a lot of debt, but they don't have a lot of equity, remember, without a lot of equity, you're going to have less partners. You're going to have a higher earnings per share because you have fewer partners. But remember, higher debt to equity, you got a lot more risk. And maybe that's why you're getting that higher return. So you want to compare apples to apples. If company A has a higher earnings per share and you're comparing that to company B, A has a higher earnings per share and they have similar balance sheets, then I'm very impressed with company's A performance. But if A has a higher earnings per share, but their numerators are similar, the reason why A has a higher earnings per share is because they have a lot more debt and less equity. I'm not as impressed. You're getting a higher return because you're assuming more risk, okay? Now, price to earnings ratio. As a general rule of thumb, we use this as a relative valuation metric. Rather than trying to figure out what the rational value should be based upon earnings, payout rate, retention rate, return on equity, growth, discount rates, and all that stuff. Instead, we just look at what multiple of earnings the company is trading at relative to the industry standard. So if the target company's price to earnings ratio, if they're trading at a lower multiple, hey, they could be relatively undervalued. You know, if they've got really high earnings per share and a low price, they'll have a low multiple. That could mean they're attractively priced. But you got to be careful. Maybe they're trading at a lower multiple because they got a ridiculously high debt to equity, or they have less growth potential. All right, so there's other reasons why you could be trading at a different multiple. Conversely, if a company's trading at a higher price to earnings, their multiple is much higher than everybody else. Well, that could mean they're relatively overvalued, maybe. Or maybe they're trading at a higher multiple for a good reason, like they have much higher growth potential. I don't know. You got to look at those other factors as well. But holding all other factors constant, well, if a company's trading at a lower multiple, they're attractively priced. If they're trading at a higher multiple, you know what? They're not as attractively priced, assuming similar growth, similar balance sheets, okay? So you got to make sure you're comparing apples to apples with those multiples. Dividend payout. Do you want dividends or not? Look, there's two ways to make money on common stock, the dividend and or the change in price. Okay, you'd like to get both. Now, some people don't want a dividend. Why not? Because dividends, could be taxed at a higher rate than capital gains. So it all depends upon where you are around the world and what the tax system is, etc. But some people prefer the aggressive growth that they retain the earnings to grow the stock price. And then, you know what? I won't get taxed on that until I sell it. Okay. So, different people prefer different things. But, ultimately, if a company pays out a lot of their earnings in dividends, well, they probably don't have as many growth opportunities that they need to reinvest the earnings. So, general rule of thumb is a higher payout could mean a more mature company with less growth opportunities, less positive NPV investments, okay? So they're paying out more of their earnings. Not that that's a bad thing. That's one way to make money. And if you're retired and you're not worried about taxes and avoiding taxes, you like that. You prefer that. On the flip side, a low dividend payout might mean the company is aggressively growing. And they can pay out the dividends because they have all these growth opportunities they want to fund from internally generated profit rather than taking on new debt or new partners. That might be acceptable as well. Okay, so how do we get our dividend payout? Tell me the cash dividends. Notice the cash dividends divided by the earnings. Another way to do it is dividend per share divided by your earnings per share. Okay, that's your payout rate. And then 1 minus your payout rate is your retention rate. So in our example, the cash dividends divided by net income is 40%. Well, 1 minus 40, what are they doing with the other 60%? Reinvesting it into the company to grow more, buy more assets, grow the business, grow the sales, grow the earnings, and thus grow the stock price. You don't mind them retaining the earnings so long as the return on equity is greater than the required rate of return. Then they're adding value for you. Okay, but if their return on equity is less than your required rate of return, you don't want them retaining the earnings because they're decreasing the value of the company. Okay, we don't mind not getting the dividend so long as they're growing the stock price. Okay, now asset turnover. We covered this earlier. We want that to be greater than or equal to the standard, the ability of the assets to create that revenue. So what is the optimal amount of inventory? What's the optimal amount of PP&E, the right number of stores, factories, planes, trucks, whatever it is. So your numerator is from the income statement, the more sales, the better. And your denominator is from the balance sheet. So we want to take an average, okay? So asset turnover. Now look, if your assets are turning over too little, or I should say if you have too little assets, let's put it that way, you don't have enough in the denominator. If your denominator is too small, you don't have enough inventory, you don't have enough PP&E to meet the demand, you're going to have lost sales. That's not good. So if you have too few assets, you're going to have really high turnover, but you're losing sales. On the flip side, if you have too many assets, you have a surplus of inventory. You have trucks that are sitting in the garage and not delivering packages. You're an airline and the plane is not flying because you don't have passengers that want to fly your airline. Well, then you're going to have a low return on asset. That's bad news, okay? So the asset turnover is driven by management efficiency, having the right amount, the optimal amount of inventory and PP&E. Too little inventory of PP&E, lost sales. Too much inventory of PP&E, you're going to get a low return on asset. It's not going to justify buying that asset or manufacturing it. Okay, the last thing here is just comparing the target company's actual performance to what you budgeted, okay, to what you thought should have happened. So it's a tool for measuring performance, actual versus the budget, the plan, the standard. We want the plan, the budget, or standard to be realistic, okay? Very useful for planning and control. You've got to have a budget, do your variance analysis to control costs, obviously. And also it can be used to evaluate performance in terms of, did we sell more than we thought we were going to? Is our selling price higher than we thought it was going to be? Was our cost per unit higher or lower than we thought it was going to be? So very useful on multiple levels. Now, it's very important we, again, know the difference between variable costs and fixed costs. Variable costs per unit within a relevant range are constant. Okay, so when you manufacture your units, your variable cost per unit, $5 per unit up to 1,000 units, okay? So there's your variable cost per unit. But your total variable cost is going to vary with volume, all right? So your variable cost per unit times the volume get your total variable cost. On the flip side, fixed costs in total remain constant within a relevant range. But when you take that total fixed cost and you divide it by the volume, your fixed cost per unit goes down. Hey, if you do an audit or tax, you understand that's called capacity utilization. That's salary, right? The more hours they get out of you, what happens to that? Your fixed cost per unit, it goes down. They make more money on you. They like that. All right, folks, when we look at budgets, it's very important that we break everything down per unit. Selling price per unit, variable cost per unit. But the only thing we can't break down per unit is fixed costs. That we need in total, okay, as you're going to see. Now, there's something called contribution margin. A contribution margin format income statement, this is cost of managerial accounting. It's very simple. You take your sales and you subtract your variable costs. The contribution margin, whether you do it in total dollars or per unit, ultimately, the contribution margin is the money you have available to cover fixed costs. And then once you've covered your fixed costs, all the incremental sales are going to fall to the bottom line and go to profit, okay? So contribution margin helps us determine our break-even point. How many units do I have to sell? Well, what do my sales have to be to just break even, cover my fixed costs, okay? Now, another reason we want this contribution margin format income statement so that we could see the variable cost versus the fixed cost. Folks, as your variable costs go up, your operating risk goes down. You're going to have a lower degree of operating leverage, a lower break-even point. Conversely, as your fixed costs go up, you have greater risk of not selling enough to cover those high fixed costs. So as your fixed costs go up, you have a higher degree of operating leverage. You have higher operating risk. And that's important when determining capital structure, debt versus equity. If you already have a high degree of operating leverage, you probably don't want to compound that risk with a high degree of financial leverage as well. Okay, so let's take a look at this example, variance analysis. The first thing we look at, first column is our budget. Second column, the middle is actual, and then we have our variance analysis. But they give us some details here. The budget is based upon 10,000 units being sold at a price of $15 a piece. Let's see. They tell us that the contribution margin would be 20%. So what does that mean? Well, if $15 is your selling price and $20% of that goes to your contribution margin, where did the other 80% go? Oh yeah, your variable costs. So if your selling price is 15, multiply that by 80%, what's your variable cost per unit? 12. So what's your contribution margin per unit? $3. All righty. Now they've budgeted our fixed cost to be, the budget is $25,000. Okay, that's our total fixed cost budgeted. Now how did we do actually? Well, they tell us here, our actual information, we sold only 8,000 units. In terms of volume, this is unfavorable. We thought we were going to sell 10,000 units. We only sold 8,000. That is unfavorable. Now we take a look at the numbers, the variable costs. Oh, by the way, your revenue, 8,000 units times a selling price. Now, what was our selling price per unit? Well, it must have been only $14 a unit. How do I know that? Because if your actual sales are 112,000 and you sold 8,000 units, your selling price per unit is 14. Nonetheless, our sales revenue in dollars, this is unfavorable. Okay? We should have had sales 150. We only had 112. Bad news. Now, the variable costs, well, we budgeted variable costs of 120. We only had 100,800. That looks favorable, but folks, that's very misleading. Why? Total variable costs are skewed by volume. It's lower because we had lower sales volume. So look, the budget was variable cost per unit of $12 a unit. Okay, so 15 minus 12 is 3. On the actual, we know our selling price was 14, 112,000 divided by 8. Our variable cost, you ready? Total $100,800. Divide that by the 8,000 units. Folks, our budgeted variable cost was only 12. Our actual variable cost per unit, $12.60. That's unfavorable. So the total variable cost being favorable, quote unquote, was very misleading. We had lower variable costs due to lower sales volume. All right. In actuality, our variable cost per unit was higher than what it should have been. And folks, our contribution margin per unit, it should have been $3 a unit. Every unit we sell, $3 goes towards fixed costs. The actual was only 1.4. That's horrible. That's well below what we budgeted. So folks, you were making a lot less money per unit to cover your fixed costs. Another way to get to 1.4, you could either take 14 minus 12.6 or take the $11,200 divided by 8,000 units. The contribution margin per unit, unfavorable. The variable cost per unit, unfavorable. Selling price per unit, unfavorable. All unfavorable. The only thing that we can really compare here, apples to apples, is the fixed costs. The budgeted fixed costs were, let's see, 25,000. The actual were 24, so that looks favorable. Okay, so that number I believe. Bottom line operating income, horrible. Okay, horrible. Since the sales volume and the selling price per unit were lower. So not only was the sales volume lower, so was the selling price per unit. They were both lower than expected. In addition, to compound that, the variable cost per unit was higher. So despite a favorable fixed cost variance, our operating income was well below the expectation. We had a loss. It was awful. Okay. And our contribution margin, profit margin per se, or I shouldn't use profit margin, the margin available to cover fixed costs, we anticipated $3 out of the 15 to go towards covering fixed costs, 20%. The actual contribution margin percentage, what was available to cover fixed costs, was only 10%, 1.4 divided by 14. So this is awful. The key is, though, that total variable cost line was very misleading. Okay, we had a lower total variable cost, but that was skewed by volume. In actuality, the variable cost per unit was higher than it should have been. Okay, so what we want to do is take that budget. We're going to call it a master budget. The 150 in sales, the 120 in variable costs, the contribution margin of 30,000. What we want to do is get the per unit amounts. So all that was based upon one level of activity, 10,000 units. So all we have to do, like we've already done, is calculate per unit amounts. 150 divided by 10, 15. 120 divided by 10, 12. 30 divided by 10 is 3. We now have a master budget per unit. So we're going to use the master budget information on a per unit basis to create what's called a flexible budget. That's going to allow for a more meaning comparison of budget to actual. It corrects for the volume variance, difference in the budgeted sales of 10,000 units versus the actual sales of 8,000. So what we want to do when we create the flexible budget is say, okay, let's take the per unit amounts, 15, 12, and 3 from the master budget, and let's create a flexible budget based upon the actual volume of 8,000. So folks, with $15 selling price per unit, 8,000 units sold, we should have had sales revenue of 120. If you take the $12 variable cost per unit times $8 a unit, we should have had variable costs right in the middle of 96,000. And if you take the 8,000 units sold times the contribution margin per unit of 3, we should have had contribution margin in dollars of 24. Now we could take that flexible budget, which we've corrected for the volume variance, and compare that to the actual results. Our sales are still below what they should have been, even factoring out the volume. Why? Because our selling price per unit was not $15 a unit. With sales of $112,800, dividing by 8,000 units, our selling price per unit was actually only $14 a unit, unfavorable. Variable costs 100 versus what they should have been 96. That's a more meaningful comparison because that same volume of activity, 8,000. So that's an unfavorable variance, and variable cost per unit 12.6 is greater than what it should have been 12. And then our contribution margin per unit again, a margin of 10%, it should have been 20%. It was only 10%, 1.4, okay, per unit versus what it should have been 3. Now, when we do this analysis on the exam, one of the questions they could ask you is actual sales revenue was lower for 2 reasons. Reason number 1, selling price per unit 14, less than the budget at 15, and lower volume. Okay, we sold 8,000, we thought we were going to sell 10. So really, when you think about it, things are really bad. You would think by discounting the selling price $1, we should have sold more units. So we discounted the selling price, and not only did we sell more units, we sold less. Okay, actual variable costs are higher even when you factor out the volume difference because the variable cost per unit, 12.6, is greater than the budget, 12. So the combination of those 2 unfavorable variances results in a contribution margin per unit, 1.2, well below the budget of 3. That means we have less dollars available to cover our fixed costs. And then obviously the goal is to make a profit. Not only do you want to cover your fixed costs, you want to turn a profit. So even though our fixed cost variance was favorable, we still had a loss because our contribution margin per unit was so low. And that was a combination of a lower selling price per unit and a higher variable cost per unit. And then that was compounded by the lower volume sold, okay? So it's not about just crunching the numbers. It's more about analytics today. So they want to make sure you can correctly analyze and interpret the data and explain why our contribution margin is so low, why we have that operating loss, okay? So it's breaking it down, first looking at the master versus the actual, and then understanding the volume difference, how that impacts your sales, because sales is a function of volume and per unit selling price, and total variable costs are also a function of volume and your per unit cost, okay? So you got to be able to correctly interpret the data just as we've done here, and you'll be in great shape. Okay, so that wraps up the ratios. If you haven't done any questions yet, you got a lot to do. If you've already done some, just make sure you go back, correct your mistakes, make your notes, make your little flashcards, anything you're worried about forgetting, write it out. What you write, you will remember. All righty, good luck studying. I'll see you guys in the next topic.